Hey folks, this is Daryl Barnes, the president of Deacon Wealth Management. And I wanted to touch base with you guys today. We're actually going to release the Outlook 2022 based on LPL Financial's research department. So it's a nice presentation that they've done. I'm going to add comments to this presentation. We're going to try to release these simultaneously so that you can actually see the PowerPoint presentation and hear my comments at the same time. So without further ado, I just want to kind of kick things off. We are a little into 2022 right now. It's actually the 12th of January when I'm shooting this, and wanted to pass this along as soon as I could. 2021 was a pretty interesting year. We were very fortunate with regard to how the year turned out with regard to the financial markets. There are some concerns that are out there, and we're going to kind of go through it a little bit. I think we're going to have another interesting year. Not to say it's going to be identical to 2021 or 2020 for that matter. We've had a couple of really strange years with regard to the coronavirus affecting things. I'm going to go ahead and kick this off. Right now, we're talking about the economy. It says from hand up to hand off. And essentially what they're talking about with regard to that particular slide is there were a lot of handouts from the government trying to make sure that the economy didn't crash when things started to come to a halt with regard to dealing with the coronavirus. Businesses were shut down. People were out of work. There were a couple of rounds of funding that went through to try to help out the American taxpayers. Whether you agree with it or not, it happened. It's out there. In 2022, we're actually going to come up in what I believe will be a little more political with regard to what we've seen over the past year, which might sound a little bit like a leap in logic, for lack of a better term. But I do believe that you're going to see this economy kind of bounce around. You're going to see the markets bounce around a little bit. And the 2022 economic forecasts from LPL are actually quite strong. In 2021, we actually had some forecasts of 5.5% growth. And in 2022, we're going to see that back off just a tad between 4% and 4.5%, which is really not a tremendous downturn. So it's, again, still going to be pretty good news. If we're talking about developed markets that are not in the United States, in 2021, the numbers were 4.6%. For 2022, we're starting to see a little bit of a decline there, a little stronger decline to 3.5% to 4%. That's the projected growth model. And then in emerging markets, we saw growth of 6.4%. We're projecting 2022 to be 4.75% to 5.25%. So you're kind of seeing these things move about 20% down across the board with regard to the growth. But remember, 2021 was substantially more growth than we were seeing in 2020 because we were coming out of the doldrums from the coronavirus. So these numbers are still very strong. And I want you to keep that in mind as we start talking about this. We do expect inflation to start calming down a bit per the projections from LPL. Right now, inflation is really hitting everybody pretty hard. In 2021, the year-over-year adjustment was 4.5%. I think if you go to the gas pump or you go to the grocery store, you're seeing numbers that are exceeding these numbers. So I'm kind of taking these numbers with a bit of a grain of salt because some of the legislation that's out there could potentially really dramatically change these numbers. And again, we're looking at an entire year, so we're trying to forecast 12 months in advance here. We're calling right now for 3.7% inflation. It's probably going to be closer to 5 if we start to factor in all of the factors that are at work. Unemployment, we're expecting that to continue to drop. It's at 5.4% for 2021, 4% for 2022. And again, this is somewhat dependent on what we see politically. If we start continuing to add to the debt for America by paying people to stay at home from work, these numbers are probably not going to be very accurate. And then we're looking for a 10-year Treasury yield In 2021, it ended up between 1.5 and 1.75% in terms of what the forecast was. For 2022, we're going to see a slight increase there, 1.75 to 2%. Those numbers don't sound very, very dramatic, and they're not. And I think that's going to make the construction market stay strong. If you are anywhere in the northeastern United States, southeastern United States, Texas, places like that, the real estate marketplace has been on fire. And when you see the 10-year Treasury yields at these numbers, at these levels, that tends to keep mortgage rates very, very low as well, which means that you can afford more house for every dollar that you want to spend. If we see those numbers increase dramatically, at that point, we're probably going to see the real estate market start to change a little bit as well. And so let's talk about stocks. In 2022, we are looking for the S&P fair value. That means this is what the S&P would actually be valued at. We're looking for a number of 5,000 to 5,100. To put those numbers in perspective, we're looking at an S&P number right now around 4,100, which that represents a pretty good growth. So the stock market should remain fairly strong. Again, it's going to depend on whatever policies we're starting to see come out of D.C. I'm not going to try to sit here and make any predictions about fiscal policy, monetary policy, tax regulations. There are some wild cards here. If we being the United States, step in to say, hey, Russia, we don't want you invading the Ukraine, these numbers are going to be fluctuating wildly. I'm not sure what that foreign policy issue is going to turn out to be, but it can be something that we need to keep an eye on. If we start to look at stock forecasts, part of this is dependent on what the Fed does with regard to rates. And we haven't seen them adjust rates up recently, but there are many economists and research analysts that are out there right now thinking that the Fed might raise interest rates as many as 4 times this year. That can get kind of dicey as well, because when you start to increase interest rates, what you are encouraging is trying to put more money back in the banks, taking it out of the economy. So if we see some drastic rate hikes, let's say that they move it 0.5% to 1%, that is really going to kind of have your foot jamming on the brakes, and that's going to cause some volatility in the marketplace. So let's try to kind of keep that in perspective as well. And then the stocks tend to rise in the year before the first Fed rate hike, which that's exactly what happened last year. Stocks went up, and we are starting to talk about the Fed increasing short-term interest rates. So I'm not a big proponent of taking money out of the marketplace. I like to see the velocity of money continue to move forward at a healthy rate. But when you have inflation hitting these high numbers, at some point the Fed will step in to try to stop some of that by making it more attractive to keep the money in the bank versus having the money out there chasing goods and services. So we've got some stock forecasts. In 2019, we were looking at the earnings per share for the S&P 500 to be at $163 a share. In 2022, that number went down to 140, and 2021 back up to 205. So it was a pretty dramatic increase there, and we're looking in 2022 to have the earnings per share be around $220. So you can see that the graph is going up from left to right, and that is typically a pretty good thing when we're invested in the marketplace. So let's talk about bonds. I have not been a real proponent of putting too much money in bonds unless you have designated known numbers of interest payments that you have to make. You have to meet a certain obligation at a certain time. If you're investing in bonds to try to generate returns versus trying to generate actual income, you're probably going to be getting behind the eight ball a little bit. We're still at historically low interest rate numbers. And there's an inverse relationship between interest rates and the price of bonds. When interest rates are at historically low numbers, you typically see historically high prices for bonds. So if you decided you wanted to buy bonds right now, you're typically buying them at higher prices than you would normally see. And what will happen is if interest rates start to head up, you'll see that inverse relationship move. The interest rates will go up and the price of those bonds will come down. So we're being very cautious with regard to bonds at Deacon Wealth Management especially. We like to manage risk by managing duration at this point. We want to get high quality securities at very short durations so that they can actually address any changes that are being made, especially at the Fed level. If the Fed makes the 4 rate increases that they're talking about this year, that's where we want to be very short on our time horizons. So we'll continue to pay attention to that. And if you take a look at this next slide, the 2022 bond forecast, corporate credit markets are expensive relative to history. Again, that's just what I said. We're paying higher prices. We want to try to avoid paying high prices as much as we can because at the end of the day, when we start talking about investments, we want to buy low and we want to sell high. That goes for bonds, stocks, real estate, anything that you want to invest in. So that's a very quick overview of 2022. Essentially what we're talking about is more of the same, meaning that we think we're still going to see some decent returns in stocks. The U.S. economy does have some challenges that we're facing right now. We have some inventory challenges. We have some potential tax challenges. There is a tremendous amount of debt that has been issued by the government recently, and those are the types of things we need to take into consideration when we are investing. It doesn't matter if you're Republican, Democrat, Independent. What I think we need to have is to see some accountability, not only for what's going on currently in the current economy, but also for our children and our grandchildren. What we don't want to do is to saddle this economy, these companies, with a tremendous amount of debt. Because if you get behind the eight ball with regard to debt, all you're doing at the end of the day is paying off interest versus paying off the actual or gaining additional equity. We like equity in the economy. If you or your family members or friends need any help, need any additional information with regard to what we're seeing in the marketplace and the way we're addressing it with our portfolios, please feel free to call us. Our number is 540-371-8585, and our website is www.deaconwealth.com. Again, I'm Darrell Barnes, President of Deacon Wealth Management, and thank you very much for joining us today. Hope you all have a wonderful 2022.